In this video, we're going to talk about how to account for selling an available for sale debt investment. So if you remember, the available for sale debt investments are marked to market on the balance sheet. So that means that they appear at their fair value. And then any unrealized gains or losses, and by unrealized, I mean gains or losses that happen because the fair value goes up or goes down, but we haven't yet sold the available for sale debt investment. Those unrealized gains or losses go to other comprehensive income. They do not affect net income. They don't go to the income statement. However, when you actually sell the available for sale debt investment, then you have a realized gain or loss potentially that will go to net income. So I want to give you an example of a debt investment where we sell the available for sale security and have an unrealized gain or loss to show you how it works. So we've got an example here of this Babu's Chocolate Factory. They issue a bond. It's issued at a discount, $92,221. So from the investor's point of view, let's say we're the company that bought Babu's debt. So we debit debt investment, $92,221. We credit cash for the same amount. And here's an effective interest table if you're interested in seeing how it's amortized over time. But at the end of year one, the fair value of this debt investment is $95,000. And we can see that that's higher than the carrying value at the end of year one. So we're going to have an unrealized gain. So first we have to account for the fact that we're accruing some interest revenue and so forth. We're receiving that. But here, this entry here, where we debit the fair value adjustment account that increases available for sale debt investment, and then we credit unrealized gain to other comprehensive income. So again, this does not affect net income. That does not affect net income. Now, let's say, now we've dealt with end of year one, and we've talked about this before, so this should be easy for you. Now at the end of year two, here's the catch. We sell our entire investment. We sell this to somebody else for $99,000 cash. So the question is, what do we do with the gain or loss? How do we even calculate the gain or loss? What do we do with the fact that we have this other comprehensive income that we booked before? Because we can't just leave that, right? We've got to get rid of these accounts here. We have to zero those out. But then we might also have a realized gain or loss. And when I say realized versus unrealized, again, realized just means we actually sold the investment. And so unrealized, when that unrealized gain, it means that the fair value went up, but we hadn't sold the investment yet. Okay, so that's all that means. So now that we've sold the investment for cash, we know that we're going to debit cash. Oh, well, actually, let me show you first. I actually have the entry just for completeness sake. As a true accountant, I've got the entry here for the interest, right? Because we credit the interest revenue and so forth. Because we held the security for the second year, right? We sold it at the end of year two. Okay, so we have the adjusting journal entry for the interest. And then we have the adjusting entry to deal with selling it for $99,000 cash. So we're going to debit cash for $99,000. We're receiving cash, right? We're getting $99,000 of cash. Now we had credited OCI before for that unrealized gain, so now we have to debit it. We have to debit it to get rid of it. And conversely, we had debited this fair value adjustment account before, but now we got to zero that out, right? So we got to zero it out. When we think about zeroing something out, before it had a debit balance, this fair value adjustment, it had a debit balance of $14.79. So what do we do to zero it out? We credit it for $14.79, okay? So we get rid of that. And again, I'm just assuming this is the only security we hold to make it easier and so forth. Now, in addition to that, we look at the carrying value. We'll look at the carrying value of our investment here. We're going to credit our debt investment for $94,937. Why is that? Well, let me do a T account for that. So we'll say this is our debt investment. Okay, so we started with $92,221, right? $92,221. But then we went and we did, let's see here. What was our second entry? $1,300. So $1,300. And then $1,417. And some of my numbers might be off by $1 here due to rounding. Forgive me if that's the case. Okay. And that gives us 94,937. I think due to rounding it actually would be 94,938, but you get the idea. Okay, so that was what our debt investment account was at. Okay, because we've increased it due to the amortization of that bond discount. Okay, because we got the bond at a discount. So that's what this is all about. But now we're getting rid of this debt investment. We're selling our position. So we got to zero this out. So what do? We credit it for 94,937, which is what we got going on right here. Okay, so all we're doing, this entry here, this entry here, this entry here, we're just zeroing out those accounts because we're not going to hold this investment anymore. So we don't want any asset that says debt investment. We've sold it. Okay, so now you know what happens with the cash because they're giving you cash. It says right there. And we know what happens with these accounts because we have to zero them out because we no longer hold this investment. So you could think of the plug. In this case, the plug is a credit, right? When I say plug, I mean that if we didn't have this number here, it'd be like, wow, this doesn't balance here. So we have to have an entry to make it balance, and that's 4,063. That's our realized gain. If the plug had been something where, okay, over here we need to get something to make it balance, then of course we'd have a loss. Now, if you don't want to think about it as a plug, and you want to think about it more intuitively, think about it like this. The reason we have a realized gain, and by the way, this realized gain is going to go to net income. This is going to affect the income statement. It's not like the unrealized gain that went to the OCI. This realized gain, let me put it here, this is going to go to net income. Okay? Now, you can think about this intuitively, this 4,063. You could think about it as, what did we actually get? Well, we got 99,000. And then we can think about subtracting the carrying value, which is 94,937. So if we forget everything that happened before with other stuff, we just think right now, well, we sold something for $99,000 and its carrying value was 94,937. Okay, and so then that gets us to that gain of 4,063. And again, we sold the investment, so this goes to net income. When we hadn't sold the available for sale security, the unrealized gain went to other comprehensive income, had no effect on net income. So let's say the manager was having a bad quarter or bad year this year. They say, oh, you know what? Let's sell this available for sale debt investment because we can go and get a realized gain, and that'll pump up, that'll increase our net income for this period. So managers can use this as a way to smooth out earnings over time. And in fact, research suggests that they do just that.